With Monday the 6th of May being a bank holiday, we've got a bit of a shortened week coming up and macroeconomic news will be relatively thin on the ground. You may also be pleased, if not relieved, to know that the US quarterly results season is starting to taper off, with just 57 members of the S&P 500 index due to release results in the week ahead. That said, we've no fewer than 18 FTSE 100 firms due to release results or host their annual general meeting in the coming week, adding a good selection of reports and updates from FTSE 250 and small cap firms, and there's plenty for investors to ponder and research. Possible highlights on the corporate front include trading statements from insurer Hiscox and Domino's Pizza on Tuesday the 7th of May, updates from broadcaster ITV, insurer Direct Line, interims from Imperial Brands and full year results from AIM-quoted law firm disruptor Keystone Law on the 8th, trading statements from Mondi, house builder Barratt, Morrison's, RSA Insurance and retailer Superdry on the 9th, and finally first quarter results from International Consolidated Airlines and an analysts meeting at Publishing to Events Group Informa on Friday the 10th of May. But for me, the company which could cause the biggest fuss in the week ahead just might be BT when it releases its full year results for the 12 months to March on Thursday the 9th of May. Now it's been another torrid year for BT, with the departure of Chief Executive Gavin Patterson after 5.5 years at the helm and a cut to the interim dividend for good measure. Mr. Patterson announced he would step down last June after a series of profit warnings, an Italian accounting scandal, share buybacks that proved ineffective, and the abandonment of a plan to actually consistently increase the dividend. He's been replaced by Philip Jansen. He arrived in February from WorldPay, and it'll be interesting to see how the new boss builds on what could be seen as the positives of the Patterson regime, namely the acquisition of mobile network operator EE, the purchase of football rights and the creation of BT Sport, a settlement with pension holders, and extensive investment in fibre broadband networks. And perhaps investors have been trying to find some positives because BT shares are down by only 8% over the last year, although I should say the FTSE 100 is broadly flat over the same time frame. Perhaps more damningly, BT shares are actually no higher now than they were in 1996, which may just indicate what a big job Mr. Jansen's got on his hands. BT does appear to be hemmed in by the regulator on one side, value-hungry customers on another, and a fearsome array of competitors on another, including Vodafone, 3, O2, Virgin Media, TalkTalk and the Comcast-owned Sky, to name but a few. This all makes Mr. Jansen's first set of results in charge particularly interesting, and at least January's third quarter results featured no further new nasties. In fact, the outgoing Mr. Patterson stated that EBITDA, earnings before interest, taxes, depreciation and amortization, sort of a cash flow proxy, would actually come in towards the higher end of the company's guided range of £7.3 to £7.4 billion, although that still would represent a slight dip from last year's £7.5 billion figure. BT also made two other forecasts for this year, so analysts will be looking at those as well. The first was for underlying revenues, which were forecast to fall by some 2%. The second was for what the company terms normalised free cash flow, which BT has said will come in between £2.3 and £2.5 billion. That's a long way down from £3 billion a year ago. Now you may at this point be thinking that with BT focus on adjusted this and underlying that, the numbers will be difficult to understand, and that frankly it won't be worth the bother of reading the report when it's published. It's going to be so complex. I've actually got some sympathy with that view, so to try and help you, the consensus pre-tax profit forecast for the year, that's just under £3.2 billion compared to £2.6 a year ago. Now that improvement will be thanks in part to a drop in the £828 million of one-off charges that related last year to the acquisition of EE, restructuring costs and that scandal-stricken Italian operation. Note from the graphic also that for the year to March 2020, analysts do expect a drop in stated pre-tax profit again to around £3 billion. This may reflect the comments from Mr. Patterson at the third quarter stage that, and I quote, "We continue to expect regulation, market dynamics, cost inflation and legacy product declines to impact in the short term before being more than offset by improved trading and cost transformation by our 20 to 21 financial year. Now the final number to note is the dividend. BT cut its interim payment by 5%, though that was actually a lot less than some analysts had been expecting. For the full year, the consensus is for the dividend to be almost unchanged, although some analysts are starting to talk about deeper reductions in the coming years, thanks to the combination of pressure on profits, a £5.3 billion pension deficit and a £12 billion net debt pile. Let's see what happens, especially as BT cut its dividend twice very deeply during its history as a quoted company, as we can see here. Thank you for watching, and I look forward to seeing you next time.